that's what I wanted to say too, was really the San Francisco Fed, we're really happy to be hosts for this event, provide the facilities. I think this is one of, to me, one of my favorite events in terms of thinking about the Bay Area economy, thinking about all the local conditions, obviously the discussion around East Bay and Oakland, and more generally where the future of the Bay Area is, but also talk about that in a broader context of the national economy and classically the global economy, because of course we're all interconnected in the financial system and the economic system we live in today. So I think that's kind of my role is to as I explained I was talking to a pilot recently, I said I try to take this up to the 35,000 foot level of the national outlook and maybe the global outlook, because I think that's really important context to think about what's happening here. After I talked, by the way, he told me, I think you were kind of at 60,000 feet, there wasn't a lot of oxygen in the room at that point. I'll do my best. I should also start with the standard disclaimer that everything I say reflects my own views and not necessarily anyone else in the Federal Reserve System. So let me just get that out there. So let me talk, I think the theme of my remarks, and I hope to have time for Q&A, so if you have questions, please prepare that. The theme of my talk is really how the U.S. economic outlook, the U.S. economy today is moving from a period where we talked a lot about the headwinds that have been holding back growth, holding back the U.S. economy, to really more of a story of tailwinds. Things that are happening now, not only in the U.S., but importantly around the world, that I think are going to help propel growth in the U.S. and the global economy over the next few years. So let me talk, I'm going to talk about three tailwinds for the U.S. economic outlook. One is clearly the fiscal policy. The tax cuts will provide a boost to growth, both in terms of jobs and GDP and all the other measures we look at over the next few years. So that's one of the tailwinds that I think is going to be in play over the next few years in a national, from a national perspective. The second, and I think is really equally important, is that a kind of a shift in the global economic environment. Over the last few years, a lot of the discussion has been about the divergence of the U.S. economy relative to what's happening in Europe and other parts of the world. The U.S. economy, we got out of the big recession following the financial crisis relatively early compared to what was happening in Europe and some other countries, and so the Fed was starting to, what we call normalize monetary policy, what people in the real world call raise interest rates. And so we were in this world of kind of our economy improving and trying to, the Fed, to get monetary policy back to normal. While in the rest of the world, it was kind of the opposite, where the European Central Bank was actually adding the stimulus. Other central banks were either keeping their foot on the gas or maybe even pushing harder on the gas pedal. And that created a pretty challenging environment for the U.S. and for the global economy in terms of this divergence. Well, today, we're seeing more of a convergence in what's happening abroad. Europe is clearly doing much better overall. We're seeing China continue to grow in this 6.5–7% rate, which I think is consistent with their longer run trends. And again, globally, we're seeing more positive developments. And what does that mean for the U.S.? It means one is better markets for exports, for U.S. goods and services. It also means that as we normalize monetary policy, and I'll come back to that it probably won't create the same kind of big movements in the value of the dollar or commodity markets in general that we have seen over the last 3 or 4 years. So again, I think that's going to be a tailwind. The last thing I'll mention is financial conditions or confidence overall. I mean, whether you look at surveys of households or businesses, clearly this is a period where people feel, I think that they're shedding, maybe psychologically shedding the feelings from the housing crash, from the recession, being more willing to take on risk, being more willing to invest in the future, and so we're seeing strong confidence there, and that's showing up in financial markets. Again, not only in the U.S., everyone talks about the Dow in the U.S. hitting a new high. If you look at stock markets around the world, again, you're seeing a very similar pattern of improvement in valuations and asset prices of the stock market, real estate, and other classes. And so, again, I would put this in the general bucket of greater confidence, positive momentum going forward. In terms of the U.S. and the global economic outlook. So again, over the last 5 or 6 years, the headwind story was really about how challenging it had been to get the U.S. economy to get the other economies back on track after what was by far the worst crisis, the worst recession that we've experienced in our lifetimes. That was a very long slog, a very challenging period. I think in the U.S. we're now in a situation where the economy is actually doing pretty well. The unemployment rate in the U.S. is about 4.1%. We talk about 4% unemployment rate. That's the kind of economy we had at the end of the 90s, around 2000. So you have to it's a very strong economy in terms of jobs, in terms of unemployment and other metrics. If you look in the 12th district, which is my part of the world for the Fed, unemployment rates are unbelievably low in some parts of the 9 western states. So Hawaii's unemployment rate, if you ever want to think about how low an unemployment rate can go, mathematically it cannot go below 0 because it's the number of people who are unemployed divided by the labor force. It's 2.0% today in Hawaii. In Utah and Idaho, it's roughly 3% unemployment. Again, relative to historical norms, this is extremely low. If you look at Oregon, Washington, California, unemployment's a bit higher than that, but still really low relative to historical norms. So we're in a national economy that's doing well, and obviously in this part of the world, the western part of the world, western part of the United States, the economy is also doing extremely well in terms of its overall look in terms of growth, income growth, employment growth, and unemployment. Now, I think that with these tailwinds that I've been talking about, I expect growth this year, 2018, to continue to be similar to what we saw last year. GDP growth on the national level, about 2.25% to 2.5%. We had 2.5% roughly in 2017. So a continuation of good, solid growth. Continuation of very strong job gains. We added 2 million jobs in the U.S. last year. I'm expecting that number this year to be somewhat lower, but still well above the pace that we need to, the number of jobs we need to create just to meet the increase in the labor force in America. So my forecast is the national unemployment rate continuing to drift down this year from 4.1% today to something like 3.7% late this year, and to stay around 4% or a little bit below over the next couple of years. Again, if you go back and for our lifetimes, an economy that's that strong, with an unemployment rate under 4% for a significant period of time, you really have to look back at the late 90s, around 2000, or quite honestly go back to the 1960s. Now, as soon as I mention the 1960s and very low unemployment rate and all that, a natural question comes up, well, that didn't end well, because the 60s was followed by something called the 70s. And that was a period that was defined by stagflation, 2 words that we do not want to be associated with the U.S. economy, stagnation and inflation. So obviously that's part of our kind of challenge in managing the U.S. economy through monetary policy, is to keep the economy growing, like on this, good solid growth going forward, good job growth, keep the economy strong, at the same time as not allow imbalances to form in the economy, especially that might lead to inflation or other problems. And so that's the fine balancing act that we're facing at the Federal Reserve in terms of policy. The good news is inflation's really low. Inflation in the U.S. is about 1.5% overall for the last year. The Fed has set a target of 2% inflation, what we want over the longer term. So we have a little bit of room to allow inflation to drift up over the next couple of years. And my forecast is, with a strong economy and some of these special factors that have been holding inflation down the last couple of years ebbing, I expect inflation to move back to 2% over the next 2 years. So, from a point of view of the Fed's goals of keeping the maximum employment and price stability, these are 2 overriding goals for monetary policy. I think we're in a very well situated now, very low unemployment, good solid growth in terms of the economy, and with inflation a little bit low, but moving back to our 2%, a longer run goal in the next year or 2. So this is a very good situation to be in. What we need to do is keep us in this situation, and that means getting monetary policy back to what we would call normal. Currently, short-term interest rates are a little bit about 1.4%. That's for the bankers in the audience, that's a lot higher than that 0.1% that we had for about 7 or 8 years. But we're gradually trying to get monetary policy back to a more kind of neutral setting in order to keep this economy, I think, like I said, in this fine balance. We wanted to continue the expansion to continue. We're in the third longest expansion of history for the U.S., going back to the Civil War. We'll soon, in the next few months, be to the second longest economic expansion in history. And, I would think a good goal for us is to try to get to the longest expansion, which was the 90s expansion, we still have a ways to go on that. So, from a monetary policy point of view, is try to get this balance, keep the economy on a good solid path. Don't allow don't allow imbalances to form that could threaten the economic expansion or undermine the expansion and maybe even lead to a recession. And to me, the right way to do that is to get monetary policy back to a more normal level, get interest rates gradually back to a neutral kind of setting. And obviously on the other side of our monetary policy, we're getting our balance sheet of over $4.5 trillion back down to a more normal levels over the next few years. I think we're very well positioned on that. I think our monetary policy decisions up to now have been moving with the economy. We're not getting ahead of the curve or behind the curve. I think we're well positioned not only to keep this economy on a sustainable path, but also be well positioned as things change. The economy doesn't always perform according to our models or our forecasts. That if the economy picks up more, we can raise interest rates a little bit more quickly and adjust policy on the fly to keep us on the sustainable path. Of course, if the economy slows or unexpectedly, we're well positioned for that. So overall, I think that the narrative of the next year for 2018 is really going to be more about tailwinds than about all the headwinds that we've experienced over the last 5 or 6, 7 years, and also more about the convergence of the global economy of solid growth, countries around the world moving more together. We're seeing other central banks now starting to raise interest rates now that the Fed has done so, and other central banks now around the world may be pulling back on the stimulus. So again, I see a global economic environment that's somewhat benign in that way, in the sense that we're all moving well together in terms of achieving our goals. And again, I'm pretty optimistic about that. Now, one of the things that I always have to emphasize is there's always uncertainties, there's always things that can change, and our focus most of the time at the Fed is really to make sure that we are understanding where those risks are, how to best manage those, and how to best position the Federal Reserve's monetary policy to prepare for that. The last thing I'll just mention, then take questions, is that obviously this is a time of change at the Federal Reserve. Jay Powell, one of my colleagues as a governor, has been appointed, nominated to be the new chair starting in early February. That confirmation hasn't been finalized yet, but I expect that to happen in the next few weeks. And clearly, this is a time where, the Fed, I'll tell you, I've been at the Fed 23 years, we kind of don't like change. Change is scary. Believe it or not, people who work at central banks by choice are not the most risk-loving people in the world. They're kind of, they like everything to be stable. If you look at our goals, we want stability, we don't like risk and things like that. But the one thing I'll say about Jay, and I've had the privilege to work very closely with Jay Powell, Governor Powell, over the last 4 years that he and I worked together. So in my view, and I know he said this too, this is really more about continuity, carrying forth the policies that I think have been very successful under the terrific leadership of Janet Yellen as our chair, and with I think Governor and soon to be Chairman Powell. I think again, the focus of the Fed is on our goals of maximum employment, price stability, keeping this economy strong, keeping it in appropriate balance, and really focused on those goals, and importantly the independence of the Fed. So I think it is change. It's a little scary for us, but I think it's not something to be nervous about. Really, I expect Jay will do a terrific job and continue hopefully with I think what's been a rather uneventful last few years in terms of seeing how the economy's doing. So that's my 35,000 plus or minus outlook.
That was a good hike.
Okay.
Yeah. So let's see where.
All right.
Thank you so much.
Thank you, Jeremy Van Vliet. I'm principal and architect. A few thousand elevation lower. Can you share your thoughts about income inequality and whether or not it's a concern or where the logical conclusion of that is?
So I think the question for those who couldn't hear was the concerns about income inequality in the United States. and the effects of that. So it's clearly something that we study quite a bit, because we have hundreds and hundreds of economists. We think about what's happening on all dimensions and all altitudes there. And so I think income inequality is a huge social issue and a huge economic issue for the U.S. In terms of monetary policy, I'm going to say we don't really have levers that affect directly. What we can do inequality directly, what we can do is affect the overall strength of the economy, and the strong economy, I think, is just good for all Americans. So I think that I go back to Mayor Schaaf's comments, really, is that what we need, it's really a lot of this is about investing in people. We know that one of the sources of inequality, especially the lower end of income, is that a lot of the jobs being created in America today really do require a lot of skills, education, training, and we need to get those investments into our economy at the youngest ages. Researchers have shown that the money spent before kindergarten, it has huge rates of return in terms of people's lifetime earnings. So when you're in your 40s and 50s, how much you make depends on what happened when you're 2, 3 years old. Obviously, K through 12 matters, higher education matters. And so these are investments in our country, and investments in our people, and investments in our economy. So if we want productivity to be higher, if we want income inequality to be less, I think these are the things that that really do matter. Well, just one last thing on that. A lot of people look to the federal government that said that's going to tackle issues, and well, what will Congress do? Actually, education is really a state and local, mostly, question. It's the local governments doing the programs and work in partnership. I agree with all the importance of partnership with business community, with community groups and things like that. State governments are the ones who are doing the provision of a lot of higher education, K through 12. So I think that you shouldn't just say, well, that's a big problem. It's, no one's tackling it. I think that these issues really can be tackled at the local level, at the state level. And I think they're really important for what does this economy look like, what's our society look like next year, 5 years, 20 years from today.
John, thanks. This is Chris DeGiorgio. I'm the past vice chair of the Economic Institute. Could you share your thoughts? Unemployment is at an all-time low, but workforce participation has been a lingering challenge. So what is your forecast on workforce participation?
Okay, so that's a really interesting question. So labor force participation, I'll do the math here just so we're clear. So the way it works is they call people and they ask, this is how the data is collected, and they ask, are you working? And if you're employed, then your account is working. If you're actively looking for a job, which means literally applying for jobs, interviewing for jobs, that will get you in the category of being unemployed if you're not currently working and actively looking. And everyone else is counted as not in the labor force in terms of the population. So the labor force participation rate is the ratio of people who are working or looking for work relative to the entire population of that category. So typically labor force participation over decades has really changes because of social or societal changes and things. Women entered the labor force in the 70s and 80s. Obviously the baby boomers of retiring affects labor force participation. But the biggest development in this in the last 10 to 15 years has been the significant decline of labor force participation of what is erroneously and inappropriately called prime age males. I was comfortable with this prime age male definition last year because it's 25 to 54. This year I don't like the regular prime age male. It's the prime age part. So I think of young. So the prime age males, he's 25 to 54. Typically in America, prime age male participation was probably in the high 80s, low 90%. Basically people were working or looking for work historically. That's come down pretty dramatically over the last 15, 20 years and has fell quite a bit during the recession and has not recovered at all. So as the economy's added millions and millions of jobs, 15 million jobs or so over, during the recovery, as unemployment's gone down to 4%, this has not budged at all. For women, the prime age, again, the same category, 25 to 54, that labor force participation fell. A lot of people gave up. I mean, the economy was very weak. It's hard to find work. they left the labor force. But as the economy's gotten better, as jobs became more plentiful, situation got better, we've seen that labor force participation move back. So the big question for us, which we're still trying to figure out, whether it's Fed economists or academic economists, leading universities and things, is what is happening here among the prime age male group, because there's still low participation, and importantly, what can be done. Now, to change that if it's due to things that can be changed. So from a as my macroeconomist, monetary policymaker hat, I think we're doing our part to help in terms of having a very strong economy, very low unemployment rate, to the extent that those folks are going to come back to the labor force, get jobs, get job training and things. I think with this very strong labor market, we're going to see how many of them come in just because employers need workers. There's been, you probably have seen these reports that employers eventually have to, be less picky about who they're hiring, and that may help people who don't have great job experience or other issues. So I think we'll learn more about this in the strong labor market. There are some real concerns that this is a whole generation or two of folks that are being left behind. That they don't have the right skills, the right training, and tragically the opioid epidemic has played a role in this. There clearly are a lot of people who either can't or are unable to get employed, get jobs, hold jobs, due to the drug issues. So I think, again, this is an issue that is being studied pretty extensively. This is an area, though, I do think that the state and local communities really need to be actively engaged on this, because this, in economists, we talk about the potential of the U.S. economy. What's the U.S. economy's potential output? Well, this is the potential right here. These are, huge numbers of folks who are left in the sidelines. They should be, could be, would be out there working, contributing to the economy, contributing to their families, to their communities, who are being left behind. So economists are working hard at trying to figure it out. I think that state, local, and other community groups and others really need to be focused on how do we, kind of understanding the causes and what kind of interventions, whether job training, whether counseling, or whatever it is that makes sense to help those people re-enter our workforce and our economy.
All right, we'll give a last question to former Bay Area Council and Bay Area Council Economic Institute Chair, Lenny Mendoza.
Thank you, President Williams, for your leadership and also using your platform as a voice to champion the causes that are important. So my question is, you commented earlier on the impact of the tax changes on economic growth. Can you comment on their effect on economic mobility? And what, if anything, advice would you have for the leaders in this room about how to address those issues beyond education that you talked about?
Well, so obviously the tax changes, again, I'm looking at the national kind of picture. The tax cuts, I think, will stimulate business spending because of lower taxes on business investment costs and things like that, and consumer spending to some extent. I think that what's different in a way there's a couple things that are different about this tax cut that make it a little harder to figure out exactly how it's going to play out in terms of the economy. So one of those is the fact that some of the changes, like the pass-through deduction, we haven't seen that kind of change in the past in the same way, so we're going to learn a lot during the next year or two how it affects things. The second is the one I think you're referring to, which is the changes in the SALT deduction and some of these, some of the other changes in there that affect differentially different parts, different states, different regions in the economy. We don't have a lot of experience, in terms of analyzing this, in terms of our models and things, but I think that the basic issue is that clearly this is going to this creates I would say it just contributes to what's already happening, which is differential costs of employment in different parts of the country, different incentives in terms of housing, whether buying, residential real estate or renting and things like that. So these are going to create some shifts around the country, but and within states around that. It's still kind of an open question how big the magnitude of this will be. I mean, one thing that I think economists have focused on is the effects on the residential real estate markets, especially in the very high cost areas with the reduction of the mortgage limits and also the limits on the $10,000 limit on the property taxes. So I think that those are going to affect some of these areas in terms of housing prices, probably have a negative effect. I think one of the other effects that's going to happen is that some of the effects of the tax cut will reduce the incentives for affordable housing, especially through the tax credits that are often used in the community development sphere. So there's a number of areas I think that these are going to differentially impact different communities. And so I think people are going to have to, understand that, and figure out how to best adapt to that. I don't have any particular advice to it. I think it's also early days to really truly understand how much this is going to affect our real estate markets, how people are going to change or adapt to these changes. In the end, in the big picture, this is a period where the Bay Area economy, the Seattle. I can list off all the cities in my district now that are just booming beyond belief. We're in a strong economy, so I think this is just an added dimension to what I think of as just a huge challenge. So I'd say the biggest challenge for the Bay Area or Seattle, LA, Honolulu, and other areas is the cost of living. That's the biggest challenge, and that's the one that. In terms of, I've heard this from everybody in the Bay Area Council, it's like, if you're going to be a successful business in the Bay Area or in any of those areas, it's almost like, being able to pay your workers enough so that they can afford to live here creates a lot of challenges, obviously, for the people who live in the Bay Area. That's a big issue. So that's the area that I think that matters the most is affordability and basically how will supply of housing and things like that respond. But I think these are kind of open questions. Well, thank you very much. It's great to be here.